What if you wake up tomorrow, check your trading app, and the stock market is closed? Not for a day, not for a long weekend, for an entire month. No buying, no selling, no access to your 401k, no way to exit positions. Just a frozen screen and a headline that says, all US markets suspended. What happens to your money, your retirement, your job? In 2026, with the S&P 500 representing over $45 trillion in market value and millions of Americans tied to equities through retirement accounts, this isn't just a Wall Street problem. This would hit Main Street immediately. So today, let's break down exactly what would happen if the stock market closed for a month and what you should be doing right now to protect yourself. First, let's get clear on what it actually means for the stock market to close. In 2026, U.S. equity markets like the NYSE and NASDAQ process trillions of dollars in trades every week. The total U.S. stock market is worth roughly $50 trillion. Over 60% of Americans have some exposure through retirement accounts, pensions, or brokerage apps. So if markets close for a month, you can't trade stocks, ETFs, or options. Your portfolio value might still fluctuate internally, but you can't touch it. It's like your financial house is locked and you don't have the key. Has this ever happened before? Yes, but not for a full month in modern times. After 9/11 in 2001, U.S. markets closed for 4 trading days. During the 1914 outbreak of World War I, markets shut down for over 4 months. So it's rare, but not impossible. Now imagine this happening in 2026. Maybe it's triggered by a cyber attack on financial infrastructure. Maybe extreme geopolitical escalation. Maybe a systemic liquidity freeze. The reason matters less than the consequence. Liquidity disappears, and liquidity is the oxygen of markets. Here's the thing most people don't realize. Prices only exist because buyers and sellers agree in real time. If trading stops, price discovery stops. That creates uncertainty, and markets hate uncertainty. But here's the deeper question. Does your money disappear? No. Ownership doesn't vanish. Your shares still exist. Companies still operate. Apple still sells iPhones. Microsoft still runs cloud servers. But you lose flexibility. And in finance, flexibility equals power. So now let's talk about the ripple effects. If the market closes for a month, the first impact is psychological. Investors panic because they can't act, and fear spreads fast. Second impact, corporate financing tightens. Companies rely on stock issuance and bond markets to raise capital. If equity markets are closed, IPOs stop. Secondary offerings stop. That slows expansion plans, hiring, and investment. Third impact, retirement anxiety explodes. In 2026, U.S. retirement assets exceed $35 trillion. Millions of workers contribute to 401ks bi-weekly. If markets are closed, contributions may still occur, but allocations can't execute normally. That creates confusion and fear. Now think about margin accounts. If someone is leveraged and markets freeze, brokers may reassess collateral risk. Even if prices aren't moving visibly, uncertainty about reopening levels can create forced adjustments behind the scenes. What about banks? Banks don't collapse just because stock trading stops, but if closure is tied to a broader crisis, like a cyber attack, confidence in the financial system could wobble, and banking is built on confidence. Would businesses stop operating? No, but investment decisions would pause, hiring could slow, consumer spending might dip because people feel uncertain about their wealth. And here's the twist. When markets reopen, volatility would likely be extreme. Think about it. A month of fear, rumors, economic data, earnings reports, all compressed into one reopening day. That first week back could see massive swings. So the risk isn't just the closure, it's the reopening shock. Now let's zoom out and compare this to history. In 1914, markets closed to prevent gold outflows during wartime panic. The idea was to stop forced selling. In 2001, closure allowed emotional shock to settle after 9/11. In 2020, during the COVID crash, markets didn't close, but circuit breakers halted trading multiple times in March. Circuit breakers exist specifically to prevent freefall. In 2026, if the S&P 500 drops 7%, 13%, or 20% in a single day, trading pauses automatically. But that's hours, not a month. A full month shutdown would signal something systemic, likely cyber-related or geopolitical. Now, here's the key point. Even during crises, markets historically recover. After 9/11, the S&P dropped about 12% in the reopening week, but within months, stability returned. After the 2020 crash, markets recovered to new highs within a year thanks to aggressive policy intervention. Why? Because governments and central banks act fast. The Federal Reserve in 2026 still holds enormous influence. During COVID, it expanded its balance sheet from under $4 trillion to nearly $9 trillion. Liquidity can be injected quickly. So if markets closed for a month, you can expect emergency stimulus, liquidity facilities, and coordinated global responses. Which brings us to the most important question: what should you do?
First, don't panic. If markets close, you literally can't sell anyway. Emotional stress will be high, but forced inactivity can actually protect you from bad decisions. Second, focus on liquidity outside the market. An emergency fund covering 6 to 12 months of expenses is critical. If trading freezes, your ability to access cash flow matters more than portfolio value. Third, reduce unnecessary leverage. Margin amplifies risk. In uncertain environments, leverage turns discomfort into disaster. Fourth, diversify across asset classes. Stocks are one engine of wealth, but cash equivalents, short-term bonds, real assets, and even some global exposure provide balance. In 2026, diversification isn't optional, it's structural protection. Fifth, invest in skills and income resilience. If markets close, it's likely tied to a broader shock. Job stability matters, multiple income streams matter. And finally, zoom out. If you're investing for 20 or 30 years, a one-month closure is noise in the long arc of compounding. The US market has survived wars, depressions, pandemics, political crises, and technological revolutions. Would a one-month closure be chaotic? Absolutely. Would headlines scream? Without question. Would your portfolio feel uncertain? Yes. But wealth is built by staying rational when others panic. So ask yourself, if markets froze tomorrow, would your financial life collapse or would it pause? If this video helped you think differently about risk, hit like so more people see it. Subscribe for smart, no-hype finance breakdowns for 2026. And in the comments, tell me, do you think markets could ever close for a full month again, or are modern safeguards strong enough? Because in investing, resilience beats reaction every single time.